Yo guys, what's up? I'm gonna show you a trade I made on XBI. So it's a pretty simple trade in terms of the instruments. There's Rich Ross and his robot army. In terms of the instruments, this was a pretty easy trade. All I did was bought a put. I just threw 300 bucks into this speculative trade. That XBI, which by the way is the Biotech ETF. So if you are looking at a specific sector in the market, you can go find an ETF for that sector. There are lots of choices for biotech. IBB is another one. But XBI is the standard. It's the most liquid. Generally, it's the best for trading options. And that's exactly what I wanted to do. So I bought at about 369 here. This is including commissions. And I sold it 851. So that's a profit of 120%. Now, how did that trade work? This was purely a technical trade. This was based on seasonality. It was based on other indicators, and I'm going to show you those in a second. Generally, if you're going to make a trade on an ETF for an entire sector, that's the time when technicals are more important than fundamentals. And the reason is those ETFs, let's take a look here. Let's take a look-see. XBI ETF. Those ETFs contain a large number of stocks, which means that if one stock has some strange event occur, and in biotechs, you have not only earnings, but you also have clinical tests, and those results can make a stock jump or fall. But if you have the ETF, what you've done is aggregated the most popular of those stocks into one big symbol, one ticker. So if you click on the holdings for any ETF, you will see what that ETF contains. So here's what we got, the index top holdings, and you've got how much it's weighted. So if you invest in XBI, for example, 5% of your money goes to this stock. All right? So you can look at it like that, but if I'm going to play a short-term trade, I'm always going to go with a stock because I'm looking for an event or I'm looking for some sort of speculation. I generally don't play short-term with ETFs. And for me, a trade like this where I'm spending half a month waiting for it, that would be a position trade for me, not a swing trade. This is something I'm going to spend a lot more time waiting for to pay off. And I will do that for ETFs, but not individual stocks. Okay, so here's what happens. I entered this position. I bought a put. And because if you're only going to put in like $300 or $400, anything I would say below $500 on an option trade, you should be pretty confident that it's going to pay off. Otherwise, even if you make a good ROI, like 20%, commission's going to eat most of your gains. So it should be a speculative trade where you want a lot or nothing, where you don't mind losing that small amount of money, but at the same time, if you make money, you expect it to be a large amount of money. So that's what I did here. I threw in just a few $100 because I didn't mind losing that, and I expected to make at least 100% of what I put in if I was right. Now, here's the trade. 21st, we got in. What the hell is this? Something come unplugged or what? What's going on? Check. Oh, why do the colors need to be changed on my computer? What the hell? No. Alright, so here's what happened. 21st of September got in, and then on the 13th of October got out. So let's take a look over here. Let's take a look. Now we're not going to look at the exact dates here, but you get a general picture of the tops and bottoms when you look at stock charts. So clearly you're going to hit a top and bottom once in a while with this ETF, and a lot of that is seasonal. If you look at the monthly seasonality going back to when that ETF was created, Can't make it much bigger than this. But if you look at the seasonality, you'll see that some months are clearly stronger for XBI. If you're going to make any investment, you're going to want to go with the Sharpe ratio because that's the best idea of a risk reward for a certain investment or short position. Now, October had a negative Sharpe ratio, has a negative Sharpe ratio based on the past 10 years of data, and so does August. So those are the best times to look for those tops and take advantage of a possible decline. And we saw that in August, at the beginning of August, it declined. We also saw that in October, it declined. So I was banking on the October one to make me some money. Short in August, short in October, the averages also pay off. You get an average loss, even though it's small, in August and October here. Now, some of the months have very large minimums, but this is most likely that market crash we saw last year, so I would just ignore that. In general, you want to look at the Sharpe ratio, the percent of positives, and the average. In this case, we were kind of betting against the grain because October has over 50% of the time is a gain. But when it does lose, it loses enough to override that majority of gains. All right, so let's look at the exact entry and why I entered here. Remember, we got in on the 21st. So that's back here. I don't know if I can... this should be good enough. Here, I'll bring these down. We're going to look at these in a second. Alright, so here we see XBI making a nice rally in the beginning of September all the way up to the mid to end September. Now, I got in on the last green day of that rally. Of course, I'm taking a short position because I'm playing long puts. That means I'm betting that the stock will fall. Now, I got in on this day. How did I know that this would be the last day of this rally? Am I some sort of genius? Yes, but that's besides the point. I got in on this last day of the rally based on a few indicators. So here's a few things. We'll look at the volatility in a second. Let's look at two indicators, two important indicators. The first is the stochastics. I prefer to use these fast stochastics because even though it's not a smooth line, it does give you it reacts more to daily changes. So if you look at the fast stochastics, you're at an overbought region whenever both of the fast stochastic lines, the green and the red line, are above the 80 here. So technically, we were overbought around the 16th of September. That's when we were overbought. Now, you don't have a real sell signal at this point. You get the sell signal under one of three different situations. Now I'm going to go from the riskier to the more conservative situations. The riskiest situation is when they're both above, when these two stochastic lines are both above the 80 cutoff, but the red then passes above, or you can say the green passes below that red line. That's the riskiest sell signal or short signal. Now we got that actually after I made my position, so we got that the next day. The second sell signal would be when the green line passes under the 80 line, and you would have gotten that on this day, the 23rd. And the most conservative signal would be when the red line passes under the 80 line, and you would have gotten that pretty much as the ETF was beginning to sell off. Now, why did I get in early? Why did I take a signal that was not there yet? Why did I treat this day as a signal even though we didn't have any of those three signals that I just talked about? Well, I was watching for a while and I was looking for an entry point because I was pretty confident this rally will probably end, and the seasonality shows us that it's not likely for this ETF to go very high in October. So I was expecting a pullback anyway. Now, because it was overbought, I was just waiting for any reason to to take a short position. I was watching these day by day, waiting for any reason. If I had seen this, I would have taken the short position the next day, gotten in a little higher. But instead what I saw was I was watching how the options market was treating this ETF. And you can watch it through the contract volume of puts and calls. Now obviously I'm playing puts, but it doesn't really matter. What you're looking for is, and you can track this by dividing them, but what you're looking for is the difference between puts and calls. So one way to do it is to take these numbers and divide them. You do the put numbers divided by the call numbers and you get a straight line. That's probably around 1. But instead what I was looking for is anything that would be indicative of a large set of purchases in a put or a call contract. And you can't really see that when you use one line. You can see that when you use these 2 lines. And I saw on this day, on the 21st, the same day that I bought puts, someone else bought a lot of puts. So I thought someone probably had some good info that the rally was about to end. I was waiting for a signal anyway, and the only things I really watch in terms of technical indicators are these 4 charts I have. So the candlesticks, the stochastics, the volatility, and the contract volume of the calls and puts. Now, when I saw that put buying, I decided I'm going to get in too, and we'll move on in a second, but I should point out why I use this volatility. If you're going to take a long put position or a long call position, you are necessarily exposing yourself to a short theta position. And what that means is, as time goes by, the value of your call option will decrease because of time decay. You don't want that to happen, so you want to either get out really quickly so that the time value doesn't decay so much, the time premium doesn't decay so much that you have to fight a really quickly decaying option, and the closer the expiration date is to now, the faster that option is decaying. So one choice is to get out quickly, but because we're playing a seasonal strategy on ETF, we know that we're not going to get out quickly. So instead, what you want to do is you want to make sure that if the option is decaying, you can predict that the gain that option makes is going to be faster than the decay from time. So the gain that the put option makes from the downward trend of XBI should override any of the time decay that we expose ourselves to. Now, if we don't have a price target, or we don't know how fast XBI is going to drop, what else can we do to figure out whether XBI is going to allow its options to increase in value? Well, one thing we know is that when the volatility, the implied volatility, increases on this stock or on this ETF, then the options also increase in price. So that volatility spike or increase could actually override the time decay if we're long on an option. Now, how do you make a difference? How do you determine that from these 2 lines? We have implied volatility and we have statistical volatility. What we care about here isn't the actual value of the volatility, but we care about the difference between the implied volatility and the stochastic or the statistical volatility. What I'm looking for generally is, if I'm going to go long on options, I'm going to do it when the yellow line, when the statistical volatility is higher than the green line. Because what that means, and that's a very rare situation usually, what that means is that the options probably are more valued than what they're priced for. And on the opposite side of the spectrum, when the green line spikes, option prices go up, but what they actually offer isn't that much. So you're overpaying for options when the green line's on top, and you're getting a nice deal on options when the yellow line is on top. Now, I bought in when those lines seem to have actually meet around here. The lines met, and that told me that the options were pretty fairly priced. So I thought I was getting a pretty good deal here, and I was, because as the days went on, you could see that the implied volatility went up, while the statistical volatility pretty much remained the same. And what that means is the options really didn't change in the value they offered in terms of getting some sort of upside or downside gain, but the price of the volatility increased in the options. So you're finding that options are now costing more as XBI fell. And the reason for that is usually when a stock falls quickly, as we can see here, these candlesticks were becoming a lot larger. When it falls quickly, the implied volatility grows and options become more expensive. And that is generally the time that you want to sell when it's at the highest. So now we're going to look at my exit. Why did I determine that I would be getting out on the, what did I get out on? 12th, 13th. So I got out on this green candlestick day, and that was when the implied volatility was higher. So I captured some of that volatility from selling at a time when the volatility had spiked. I captured some of that volatility gain. And you can know how much your option actually gains from volatility. Oh, great. Okay. Oh. E-Trade Pro. What a great program. I guess we're using this, option chains. Alright. So let's type in XBI here. And what we're going to do is we're going to look at a value called Vega. We're going to add that in. Vega. So we're going to add in Vega. And now we're going to have this Vega value here. Vega tells you the price the option changes for every 1% change in the implied volatility. So let's say we buy the November 18th call option on XBI for these popular ones right here. And there's Vega. So our Vega here is 0.07. which means that every time the implied volatility of XBI increases by 1%, this option that we're holding increases by $7. Now look at theta. Theta is 0.04. For every day that goes by, we lose $4 due to time decay. Now, because Vega is higher than theta, as long as the volatility of that underlying of XBI is increasing by 0.5% per day, then we're equaling out the theta decay, and essentially there's really no time decay that we have to worry about. Now that's assuming that we know that volatility is going to rise, and if we're going to take a short position, that's generally true. The volatility rises more quickly when a stock is falling, so if we're going to bet that the stock is falling anyway, we may as well go along volatility, and in that case a long put is a very reasonable play. Now, why did I get out exactly on this green day? Well, that goes to a little algorithm I've written where I look at the day-by-day candlesticks for each ETF, and I just run a quick program, and it gives me the expected value for what's going to happen on those days. So what I found with XBI is that it has this trait where if you have a red candlestick day, obviously if you're going to use common sense and want to get out of this position, you would probably say, hey, you should get out on a red day, right? You should get out on a day when the stock has fallen and capture that daily decline. Well, statistically that strategy is incorrect, because statistically XBI, when it shows a red candlestick day, is very highly likely to have another red candlestick day afterward. So selling on that day is a little silly, because it's very likely that you're going to have another one of those days. So you ride that down basically until you get that green candlestick day, and then you know that perhaps the trend has stopped. Perhaps. We don't know. So on that day, that was enough for me. I felt that the trend was probably near its bottom. I was wrong according to the close of yesterday, but not according to the open. So what happened was, I got out on this day. I captured profit at around the 61 mark, and then the next day it opened at 62. So it looked like I was right, but it fell again, and we might see it bounce back. We might see it continue to fall. Again, what you can do is exactly what I just did, but you can take a long position. And you can see here that the stochastics are telling us that we are in the oversold. It's the opposite of being overbought. We're below 20. Now we just wait for that signal. And when we see that signal, whether it be the green line crossing above the red line, the green line crossing above the 80 or the 20 line in this case, or the red line crossing above the 20 line, that's our signal to buy. And if you're going to buy, the problem here is that the implied volatility is so high, it's going to make calls more expensive than they should be, and I wouldn't really recommend taking a long position just through long calls at this time. There are other positions you can take, for example a long synthetic that deal with the vega. It'll give you a zero vega, so you don't even have to worry about the changes of these volatilities. Alternatively, you can bet that vega is going to fall, or the volatility is going to fall, and use a strategy that takes advantage of that. For example, you can use a bull credit spread. Now, another reason I probably wouldn't get in at this moment is we still have a lot of put buying. The speculators are saying that XBI is going to continue moving down south. It's going to continue this sell-off. I'm not so sure. I'm happy taking that 120% ROI. And the reason I'm a little worried about people who are going to be taking either position is, like I said, first of all, there's a lot of people taking the bearish position, but if you go back to the seasonality, you see that November's pretty good for biotech, and actually late October to when? I'd have to double check, but late October is when the biotech rally generally starts. From a seasonal perspective, every sector has its own bullish season, and XBI starts at the end of October. So I was going to get out at the end of October anyway. I want to avoid that bullish seasonality. Now, I think the seasonality will probably come into play. It does almost every year. So taking a long position on biotech is probably going to be a good decision soon, but not now. Even though it's oversold, there's too much speculation going on. There's too much implied volatility. Options are too expensive at the moment. Unless you're looking to sell options, I would stay away, especially when you have all of these speculators buying an unprecedented amount of puts, showing that the speculators are banking on XBI going further downward, probably breaking some sort of level of support. We can take a quick look and eyeball level of support here. If you go back, let's go back 120 days. I mean, we're still pretty high in the... If you look at where we are now, we're at the previous highs. So it's possible we go down to the previous lows at 50. I'm just not going to speculate on that. I'm going to say I'm happy with this this bearish trade. We made this trade in Copy My Trades. You can go to my websites to join that subscription service, but we played this based on seasonality. You're going to find seasonality plays in Copy My Trades, and probably only YouTube. I write a few seasonality trade articles on Seeking Alpha, but generally these are more private trades because I justify them purely by technical analysis, and that's usually not what most investors want to base putting their money down on. But for the rest of us, these four indicators are pretty good for making such seasonal trades, especially on ETFs that smooth out the individual idiosyncrasies of the stocks involved in that ETF. So again, what you got is the candlesticks statistics. You might have to do your own algorithm there. I use the statistics to find very detailed exit points and entry points based on whether the high, the low, the red day, or the green day is the best day to get out. Stochastics can give you an idea of when a trend is going to reverse or even out. The implied volatility versus statistical volatility gives you an idea of how options are priced relative to what they really offer. And then finally, looking at this chart gives you an idea of where people are speculating. Do people think that the ETF is going to go further down, or do they think that the sell-off is over and it will start to bounce upward. You compare the puts to the calls and you can get a pretty good answer to that. Alright, I think that is all I had to say here. Again, if you make this type of play, I don't put a lot of money on these speculative seasonal plays, but if you wanted to, you'd find that these position trades are actually pretty safe if you don't use options like I did. My option strike price here is 70. Let me see where that was in the scope of things. I think this was the day. This day. So I bought a slightly in the money option, and that's generally what I would recommend you do. Go with in the money or at the money options for these types of plays, and that will allow you to get a decent delta for the price. What I mean by that is, if you look at these again, you're going to see a value called delta. Think of that as the number of shares that you're holding or shorting. So for calls, if you're going with an at the money or slightly in the money call, you're basically holding 60 shares of that stock. So I would go with one of those. Again, if you're looking to go long on biotech at the moment, wait for some better indicators, and when they come, you can probably get in pretty safely, as long as you don't feel that the election is going to shake things up. Alright, that's all I got to say. Please subscribe and like and leave comments and leave requests, blah blah blah, for this video. Yeah.